Hello everyone, my name is Joseph Kilonzo Kioko. I'm an accountant, internal auditor also of Kenya. Yes, I'm here today to talk about KASNEB. KASNEB, deals with the examination towards the CPAs, Certified Public Accountants of Kenya. For those who are familiar about the syllabus has changed from the recent years. We have omitted the sections we had, like we had part 1, which had section 1, 2, part 2 had 3, 4, and part 3, which was the last level, had 5 and 6. But now we have foundation, intermediate, and advanced. The sections, after the revision towards the KASNEB body, that revision on the same. But now the biggest challenge is about the advanced section part of it. And today, I want us to talk about advanced financial management. Advanced financial management, it has been having some challenges to many students. Tackling the question. Sometimes you find someone has sat for that paper for more than 3 times, 4 times. It is a technical bit of it of handling the questions. It's about the fact, saying the fact towards give the fact towards the questions. And today I want us maybe to have maybe an example of some of the questions which are being tested from advanced financial management. I'll start maybe with some past papers. I like tackling most of the time past papers from maybe 2006 to maybe around 2015, 2014 there. Sometimes these exams are being repeated. You find the question has been tested for some years, then you get it maybe being tested in the previous year, on the present year that I'm talking about. So today, we are going to deal with advanced financial management. It is an advanced section, part of it. For now, you're going to have, it has a lot of, advanced financial management has a lot of chapters and maybe subtopics on the same. But today I want us to talk on our financial decisions. On the chapter of financial decisions. Under financial decisions, I'm going to talk about Mondegilian and Miller, MM theory. I'm going to handle a question on MM theory. We can go to December 2007. December 2007, question 1. December 2007, deck 2007. Question 1. B, let's start with the B part of it. Yes, the question reads, Downward Limited, an unlevered firm, generates an average earning before interest and tax of shillings 20 million per annum. Most of the time I like for students, for you to understand the question, first read the question without answering, then you come back again and start analyzing the question. That is the best way to do about it. The market value of the company is at 31st October 2007. The company financial year ended, year end, was 120 million shillings. The management of the company are considering the use of debt finance. The moment you hear about debt, we're going to talk about present value interest factor about the debt. Then you're going to have, and I'll provide the additional information. That is the additional information towards it. We have number 1, the estimated present value of the future financial distress cost is 80 million. The probability of financial distress could increase with the leverage according to the following schedule. Is that they have incorporated debt to the value of the firm. The value of debt, we are going to have it is 25. Maybe you can read on your own probability of financial distress if you have this paper. Then we have number 3. The corporation rate of tax is 30%. Then required the company cost of equity and average cost of capital, WACC, as at 31st October, that is 2 marks. Roman 2. The company optimal level of debt finance using the Mondegilian and Miller with tax model, excluding financial distress. The MM, you're talking about the MM theory. Here we are going to have, with tax model, excluding the financial distress, the company optimal level of finance, debt finance using the with tax model incorporating financial distress cost. So, this question is not that difficult. You start by analyzing it, maybe and understanding, maybe the terms being used here. So, as I've told you, the best way to tackle these questions is to start from analyzing the question the way it is. Then you come picking maybe the salient or the important parts of the points. Then you come to talk about maybe bit by bit. We are going to start maybe reading the question again, maybe to extract some vital parts. That was an unlevered farm. Unlevered farm, we say, is a farm which is equity financed. Equity financed. All equity financed. So, when you talk about unlevered farm, there is an average earning of before interest, EBIT. So, you're going to have earning before interest tax shield is going to be shillings, 20 million. Then, per annum, the market value of the farm at the 31st October 2007, the company financial year ended was this one, value of the farm. Value of, sometimes we call value of levered farm, was shillings 120 million. Then, the management of the company is considered using of the debt finance and provide the following additional information. Let's come to the part of required number 1. Roman 1 is asking the company cost of equity and weight average cost of capital. Wakaka is that first. Roman 1, we are being asked about cost of equity, what we call K. This is what we call cost of equity. Equity. And if you have done, maybe you have done what we call weighted average cost of capital, you realize most of the time we say K is equals to Wakaka. K is equals to Wakaka. And for this, you're going to have, for the value of the farm, value of a levered farm is given by EBIT. We have the tax model there. Then all over Q. So from this question, we need the Q. So you're going to use the substitution about making Q to be the subject of the formula on the same. So we say Q is equals to EBIT 1 minus T all over value of the farm or levered farm. From here, my board may be small, but you have to understand me. I can use maybe the part of it, K. We want the K part of it. So K is equals to EBIT. EBIT, we have it here. So that is 20 times, in brackets, this one is take is 1 minus 0.3. We had the corporate tax. Corporate tax is equals to 30%. That percent is equals to the same as 0.3. So this one we're going to subtract all over value of the farm. Value of the farm is 120 million. 120. So Q is equals to, this one going to open the brackets. You don't need to go to that route because you know a lot of things to open the brackets, multiplication. We are going to take 20 times 0.7. After subtraction, you're going to get 0.7 divided by 120. You get 0.116. Then you multiply by 100 to get in percentage. So this one is 11.67%. That's simple. And you have said Q is equals to Wakaka. So that is the same. You have your 2 marks. We go to the second bit of it, Roman 2. We are talking about the company optimal level of debt of finance using model Gillian and Miller, with the tax model, excluding the financial distress. So we say the value of the farm is equals to of a levered farm. Most of the time we are talking about the value of levered farm here. So we come to, when we include the debt concept, value of levered farm. Levered farm is when you say it's a farm with what? Debt. It has debt in it. So is equal value of levered farm is value of levered farm plus present value, interest, tax shield. You have to understand this concept about it, Mondegilian and Miller. When we say the value of the levered farm, you're going to talk about value of a levered farm plus present value, interest, tax shield. And to get present value, interest, tax shield, present value, interest, tax shield is given by what we call the debt component times tax rate. That is what we mean by present value tax shield on the same. So we're going to use the information being given under number 2. The probability of financial distress will increase with the revenues according to the following schedule. And not what we are being told under the brackets, exclude financial distress cost. So here we're going to have the value of debt, value of levered farm is given to, we're going to analyze the value of a levered farm, of which value of a levered farm we have each year is 120, then plus present value interest tax shield, which we have said is debt, and debt component we have here, which is 25, times tax rate, which is 0.3. We can list all of them, then we come maybe to addition and finding the addition towards it. So this is, we come to 50 plus, is 50 times 0.3 is equals, it's got the second one, value of the debt is 75 plus 75 times 0.3. We got the other one is 100 plus, 100 plus, no, not 100. It's something I'm making some mistake. I'm supposed to have value of the farm first before the debt. Sorry for that, 120, 120, 120. Then we're going to have 100 times 0.3 is equals to, we're going to have 120, which is value of the farm, or levered farm. 120, these are going to be 125 times 0.3 is equals to, they are going to have the second last about each, 120 plus 150 times 0.3, we have it in bracket. Then we have this one, 120 plus 200 times 0.3 is equals to. Now we can compute using a calculator. We start with the first one. You can start with the brackets, maybe that you add this one. Well, this one is our basics. We have learned these things in the high school, even the primary level part of it. 120. So this one you get 127.5. So the other one is 50 times 0.3 plus 120, which is 135. These are in millions. We have the other one is 75 times 0.3, which is 22.5. We have, plus 120, meeting part of it here. So let's go again, 75 times 0.3 plus 120, 142.5. We have 100 times 0.3 plus 120, that is 150. We have 125 times 0.3. We have 37 plus 120, 157.5. Then we're going to have 150 times, I think I've not omitted anyone of it, maybe, plus 120, so 165. Then the last one, 120. 180. So we go to the question. What is the question asking about? The question is asking the company optimal level of debt finance using the Modiglian. We say, most of the time we say the optimal debt, we say it's where the value of the firm is maximum, but cost of capital, sometimes we call WACC, is minimum. That is what we call the optimal value of the firm. So it's about the value of the firm, whereby the firm is it's where the value of the firm is the maximum, but cost of capital, what we call WACC, is what? Minimum. So here is about the value of the firm is the maximum. Where do we have the value of the firm maximum? Is this one. And the value of the debt, the maximum part of the firm, is going to have 200 part of it on the same. So that is the value of the firm at this maximum level part of it. And the value of the debt, the value of the firm is maximum, but the value of the debt we're talking about on the same. So this is the part we are talking about. We are talking about the value of the firm. So that is what we had for the 6 marks. Then we go to the last part of it. Maybe I'm going to include it here. The company's optimal level of debt finance using MMM tax model in cooperative financial distress. When you're going to have in cooperative financial distress on the same, we are going to talk about the value of levered firm is equal value of unlevered firm plus present value interest tax shield minus financial distress. And under here, we had our financial distress. Read from maybe the management company is considering not one, maybe. The estimated present value of any future financial distress cost is 80 million. So we had financial distress is 80 million, shillings, 80 million. So we are going to repeat maybe the same thing, but here we have already this one. So you're going to be subtracting from here the value of the firm. So we say the financial distress is equal to 80 million. So you're going to have this one. I've told you you're going to replicate what is one. What we have gotten here from here, like for the first one, we are going to use value of levered firm is equal to 127.5, then minus into brackets. We're going to talk about the present value interest. We are not going to talk about that one, I'm sorry. We're talking about financial distress here. And here we see we have probability of financial distress. For the first one is 0.0 times 80 is equals, let's just list them, then you're going to compute them later. 135 minus, we have 0.125 times 80. Financial distress is constant all through. So we have 142 minus 0.0250 times 80. Then we have the other one is 150 minus 0.0625 times 80. We're going to have 157.5 minus 0.125 times 80. We have this one is 165 minus 0.33125 times 80. Then we have second last here. This is second last or the last one. I omitted then one maybe. I think the last part of it, 180 minus 0.75 times 80. So this one you're going to compute. Also, I don't need to maybe introduce about brackets, board math, these things we have learned since from kindergarten on the same. So the first one, because we have 0 somewhere, we're going to have the same value because the multiplication to our 0, this is in millions, don't forget. So the second one, you're going to have 0.0, and it's better you start with the brackets, but I've said I want to teach you maybe about maybe the brackets part of it. Yes, because everything here is supposed to be considered to be, you have done it maybe in your lower levels of education. So that one, we got second one, this one, 0.125 times 80. We have 135 minus answer, 134. This one is 0.025 times 80. 0. Are you making? You know, math is all about speed and accuracy. Speed and accuracy. May have speed, but accuracy may draw you. Because sometimes under the bus. So we go to this one. We can confirm maybe. It's better to confirm instead of to rush maybe to give out the answers. And you have gotten them all wrong. 150 minus 5, 145. We have this one, 0.125 times 80, 157.5 minus answer, 147.5. There are 0.3125 times 80 is equals minus 165. Minus answer 140. We have 180. Maybe minus in brackets 0.750. 50. After 0, we don't have the right side. We don't say maybe 0. I'm tempted to maybe to repeat on the same. I told you math is all about speed and accuracy. But sometimes you may rush and you find yourself committing some this one, is it coming the same way? So I'm trying to proofread. My school teacher used to tell us, don't rush before you start committing those silly mistakes. You see, like this one, I've suspected it, 140. You commit some silly mistakes which will haunt you for the rest of your life. Maybe you don't ask this about doing it and completing, yes. 0.125 times 80 minus n is okay. 0.312 times 80 minus 165 minus answer 140 being 0.75 times 80 minus 80 minus answer 120. It's okay, it's okay. Yeah, so you find everything is okay. The first, those are the financial distress we are talking about. With the inclusion of the financial distress part of it, number 3. So the question is about, we have not answered the question, the same way with this one. This is the optimal, maybe the optimal part of it. They're asking about the optimal level of debt. I've said the optimal level of debt is where the value of the farm is the maximum, but the cost of capital, the OKK is what? Minimum. With the debt of 200, if the corresponding debt is 200. So the same we're going to do here, 200 million. So the optimal level of debt, that is optimal level of debt. This one, 147, with the debt value of, the debt is the corresponding, the third from the last, of 125. Yes, we are through with that question about I've forgotten to write the question, maybe this is deck 207, question 1B. December. Question 1B. That's so. You are home with your 14 marks. The total marks for this question was 14 marks. 14 marks. So quite okay. After doing this question, we have a 14 marks. I've told you sometimes it replicates the questions. Repetition of the question has been the norm of the KASNEB, maybe most of the time. For some previous years, you know, sometimes we may revise for the maybe current year. It's okay to revise, but don't be forgetting maybe to check on those previous years. So you're going to have another question. Going to have December 2016. There is a question there I want us to tackle with the same Modegilian and Miller. The questions. The same question, maybe related question the same. Uh, 2016, let me check 2016. Is it November? Yes, I've gotten the question. It is November 2016. November 2016, I can wrap this one now. So we are still on advanced financial management. Most of the time people abbreviate it to FM. So we're going to have another question, maybe. On question 3, let's go to what we have December 2016. Question 3B. But I'm doing maybe summation questions or maybe what we call calculative questions. Don't omit the theory part of it. The theory part of it maybe sometimes it can make you see places. Yes, be inclusive, be reading between the lines, everything, grasping all the concepts you're being taught by the teachers on the thing. So help you on the same, but calculation bit is one which has some challenges maybe sometimes on grasping. So we are going to have this one. These questions be, starting with reading. Maju Limited is just about to commence operation as an international trading company. The firm will have book value of assets of 320 million, and it is expected to earn 16% return on these assets before interest and taxes. This is something you need to note. So we are going to have earning before interest and tax. We need to calculate about it. Then, however, because of the certain tax arrangement in the foreign government, the company will not pay any taxes. It is known that the capitalization rate for an all-equity firm. So that is what we call unlevered firm which is fully equity financed. We're going to say in a business is 12%. So don't forget that is what we call cost of equity of a unlevered firm, that is 12%. Then the company can borrow debt to finance at the rate of 7% per annum. Cost of debt, that is 7%. The management is in the process of deciding how to raise the required 10 million debt finance. Assume the Modegilian and Miller assumptions apply. This is the value of debt. Value of debt is 10 million. Yes. So we have been told here, required using the model without taxes, determined without taxes, And like our key part is about taxes, not debt. The current value of the unlevered farm. The value of unlevered farm, as you have maybe we have seen from the previous maybe demonstration, value of unlevered farm is given by earning before interest and tax. We have tax model, but here we are being told you're not going to have the tax model over Q. But here we need to calculate first the earning before interest and tax. We are being told the farm will have a book value of assets of 320 million and he expects to earn a 16% return on these assets. So to get here book value, you're going to get 320 times 16% of this one. So you can calculate maybe on part of it. I've told you calculation is very simple as long as you have a good calculator times 0.16. That is 51.2 million. So because we have everything here, we can get the value of the farm. Value of the farm we are going to have is equals to earn before interest, but here we are not going to consider here because we are being told without what? Without taxes. So EBIT is 51.2 over K. K we have it, this is the K, which is over 12. So that is the value of the farm. We're going to talk about it, 51.2. This is your 12%, don't forget. It may affect so much on your calculation. So you're going to get 426.67 million. That's all. Simple, very simple. The current value of the levered farm, if it uses 10% debt, value of levered farm, levered. So you're talking about now, that was Roman 1, Roman 2, part A part. We are talking about value of what? Levered farm, of which we get the value of levered farm is called value on levered farm plus present value interest tax shield. And here we have the value of levered farm here. A levered farm that is 426.67 plus present value. I've told you in the last previous classes we called the tax rate. We get by using the tax rate, then we multiply by the debt. Here, we have the debt component of it, cost of debt, 10 million. 10 million times tax, which is 0. So you're going to get the same amount too. The value of levered farm is equal to the value of unlevered farm, as long as you don't have tax in it. That's all we're talking about it. Then we go to the weighted average cost of capital of levered farm as a debt level of 7%. So here is going to have some little maybe calculation on the same. So here, they are asking us what we call WACACA. WACACA is equals weight of equity, cost of equity, plus weight of debt, cost of debt. Then we have 1 minus T. But here, we are not going to use this because we are being told without what taxes. And here, we're going to talk about the value of the farm. We say value of the farm is value of equity plus value of debt. And here we have the value of the farm. The value of the farm is 426.67 is equal to value of equity. Equity we don't know, but value of debt we have it, which is 10. We have value of debt 10. So value of the equity is equal to 426.67 minus 10, which you get is 416.67 million. This one is to help you for finding the value of the farm and value of equity and also debt will help you to find what we call the weights or maybe proportions. We are going to get the proportions on the same. So the proportions here, we are going to start, maybe we may start with weight of equity is equals to, because we have, now we have weight of equity part of it, not equity, we have the value of equity. Equity is 416.67 over the total cumulative to get maybe the proportion. The cumulative is 426.67. Then we have the other one, weight of debt. Weight of debt is equals to 10 over 426.67. We can calculate this one. When you have maybe when you have weight of equity, you can subtract maybe 400 because weight cumulative towards it is 100%. So we're going to have 416.67 divided by 426.67, which is 0.98. Maybe we round off. This is what we're going to be, after calculating, maybe we're going to get is 0.02. Mostly because it has to sum up to 100%. We can check 10 divided by 426.67. Yes, you get 0.023 something, yeah. Then after that, there is something else we need to check about it. There is this component part of it, we don't have it, cost of equity of that farm, what we call cost of equity of levered farm is given by Q plus Q in brackets Q minus cost of debt of equity. Then we don't have tax components. We could have included 1 minus T, but this one is not there. So we are going to have Q already we have it is here. Cost of equity of a levered farm, which is 12, plus 12, minus cost of debt, which is 7. Then we take this one, debt over equity, debt we have here, cost of debt is 10. Then cost of equity, it is here, 416.67. I can advise, even in our proportion, you start with this one, dividing the proportion towards debt and equity, 10 divided by 416.67. Then you multiply this one, 12 minus 7, that is 5. You multiply by 5. Then 12 plus answer, that is 12.12. You round off. That is, most of the time, that is weighted average cost of capital. Wakaka, no, we have not done the Wakaka part of it. So for Wakaka, we say Wakaka is equals to weight of equity. Weight of equity, we have it, is 0.98 times cost of equity is equals to 12.12 plus weight of debt is this one, 0.02 times cost of debt, which is 7. We have it here. Cost of debt, which is 7. You calculate, you get it in percentage. You can start with the bracket 0.98 times 12.12, then plus in brackets 0.02 times 7, which is equals to 12.02, maybe in 2 decimal places. So we are through with the, is it part B? Part B. Is it? Yes, part B. The question had part B, sorry. This one I could have written, this is part B. So we are going to have part C on the same. So the part C we are going to be told, the part C is talking about assuming the company B above now pays taxes at the rate of 30%. So we have the aspect of tax, which is 30%. And you're being told, compute the following in Modiglian and Miller world. So we're going to talk about MM with tax model. MM with tax model. We're going to have MM with tax model. You're going to start again with the Roman 1. Roman 1 being asked the current value of the farm if it uses debt. Value of the farm if it uses debt on the same. So we start with the value of a levered farm is equal to EBIT. I don't want to go there back again. You can't be having maybe formulas all the time. We are doing this summation. We're going to have EBIT. EBIT is earning before interest and tax is 1.2 times tax model. I've told you, we have to 0.7. You know why? Is 1 minus 0.3. So you divide by cost of equity, which is 12. So this one, we're going to have 51.2 times 0.7 divided by 0.12. which is, maybe you should do again, 51.2 times 0.7 divided by 0.12, which is 298.67 million. That is the value of the farm with the tax model part of it. You have incorporated tax. That's why this one is supposed to be EBIT 1 minus T, part of it. That's why I have said this is 1 minus 0.3. You've gotten this one, the number. Don't be worried about maybe 0.7 where it has come from. So we go to the second one. The current value of the farm, if it uses the debt level of 7% and shillings what? 10 million. So you're going to have the value of the farm, value of legal farm is equal value on legal farm plus present value interest tax shield. I've told you this is what it means in this one. So you're going to have, this one has the debt model part of it. So you're going to talk about 298, what we've gotten here, 0.7, and as what the tax. Tax, we are being given tax here is 30%. And the value of the debt is 10M. So this one, you're going to have 0.3, you start with the brackets, times 10 plus 298.67. So this one is 301.67 million. We proceed. We are through with that one. We are through. You have your 2 marks already. So we go to the last part of it, maybe a bit of it, Wakaka. Wakaka, we have said here, we have talked about Wakaka, given the formulas about Wakaka. So yeah, you're going to use maybe the same concept we have calculated towards it. We say the value of the farm is value of debt. I don't want to repeat the formulas again. So we're going to say is about, we are going to say value of, let me just repeat for those who have maybe joined late. So value of equity, we need the value of equity. Here we have the value of the farm, 1.67 is equals to value of equity, we don't have it, is equal to value of debt. Debt is 10. So this one you're going to have, the other side is going to be, we are going to have, value of debt is going to have minus 10. We're going to have 291.67 million. That's 291. We are going to have, my space may be small, but maybe I'm trying to analyze, I'm going to get it about it. So we have that one. We need the proportions, all the weights. We can get the weights or proportion maybe in terms of, because we need the weights for weight of equity and weight of debt. So for this one, for the weight of equity is equals to, because we have equity element here, 291.67 divided by the total, 1.67 is equals to weight of debt is equals to, maybe I've told you the weight of debt, you do the subtraction towards, when you get this value, you subtract here. So we are going to 91.67 divided by 301.67. We're going to get 0.97. This one obviously is going to be 0.03. So after that, we can have now the cost of equity of your farm. I've told you the formula about it. So you're going to talk about Q plus 12 minus 7. Debt of equity. We have our debt. Where is the debt? Debt is 10 over equity. Equity is 291.67. Then here we have tax model. So 1 minus 0.3. Tax model and that part of it. So you start and divide by 291.67 answer times 0.7. Yes, then you multiply by 5. Then you add plus 12. You get 12.12%. Similarly, maybe the can will be the same. Then you go to the Wakaka. Wakaka. you're going to have 0.97 times cost of equity. This one we have gotten here, 12.127 plus 0.03 times cost of debt is 7. Then you multiply by 0.7 because of this part of it. I've told you when you have this tax, when you have tax, you have to include this proportion of tax on the same because this one has tax. So you're going to have, you can start with this bit of it, maybe you add the other one, or it's okay. You can have in brackets 0.97 times 12.12 into brackets plus 0.03 times 7 times 0.7. You are going to get 11.90%. That is the answer. You are home. You know how many marks? That is, we had, this one is, the first one we had 3 plus 4, that is 7, 14. You know, you have 14 marks, 14 marks. You're good to go, 14 marks. You're good to go. So that is, I've done the 2 questions about financial decisions. So for the class of today, I think we are okay with it. Yes, maybe we meet next time to tackle other questions or as advanced financial management. Yes, thank you, everyone.